So yes, fear post-March panic within the bond market, and we did originally see that in the bond market move index, which back then looked like it would have created some contagion in equities and prop up the VIX index equivalent. Having said that, just hearing you on the onset, tech is leading once again with a new year highs. If you look at the FANG index, and so that is propping the S&P 500, the Nasdaq higher. On the S&P 500, we do need to still break the February peak highs at 4,200 to really prove that bulls can be resilient enough to disprove a potential bear market rally and push higher.
So what does the inversion mean in your world? I mean, as you look at it from a technical perspective, how do you assess its value in signaling what happens economically?
Yes, so the clear correlations in terms of how that signals late economic cycle, it does have a lagging effect of anything from 6 to 12 months. And of course, that time window can narrow according to market conditions. Right here and now, what's interesting is that after the relatively hawkish tone of the FOMC, that if we use this as a sentiment indicator, it has helped drag the 10-year versus 3-month yield spread to a minus 168 basis points. So it's the deepest inversion in decades. So that further accentuates the situation. It's not a market timing tool per se in the near term, but it is still something to be watching right here and now.
Ron, what comes next is key, I think, on markets as we set up the earnings season in particular. And looking at the S&P 500, you look at the downside risk into the second quarter. The levels that you're talking about in the risk zone, 3,700 to 3,810, that is well below the 4,100 plus that we're seeing on the S&P 500 index at this point. So just talk us through some of those key risks investors should be mindful of.
Yeah, so risk levels in terms of the prior key lows that were set in March. So going back to the fear that was triggered back in the March panic following the bank crisis. So that remains in the memory of the market. And so we do need to be looking at some of the near-term levels, but ultimately the key support level that you just cited there near the 3,800, 3,770 mark, because if and when they do break, and of course breaks can happen fast, particularly if volatility spikes again, then we would inevitably get a revisit of the October lows, which did set this bull market rally up. Again, keep in mind that tech is primarily driving this rally. If you look at the FANG index, that has seen new highs. So if that were to reverse, then the risk scenario is something to continue to watch. Worth looking at the S&P 500 equal weighted index as a more fair value market analysis, and that still remains weak at the moment.